borrowed money. The Federal Reserve raised interest rates today in an effort to tame inflation that is soaring at a 40-year high.
Are we on the brink of another economic perfect storm? In 2022, with inflation soaring to a 40-year high and interest rates climbing, the fear of stagflation reemerged. How close are we to that grim reality today, and how can you protect your investments? Normally in economics, when things slow down, like fewer people getting jobs, prices should stay steady, or even drop a bit because there's less demand. But during stagflation, prices don't play by the rules. They keep rising even when the economy isn't doing well. This makes it tough for people because they have to pay more for things, while also facing the risk of not finding a job easily. Stagflation wasn't supposed to happen, according to older economic theories. Back in the 1970s, when oil prices shot up unexpectedly, it caused a big mess. Suddenly, everything became more expensive because transporting goods became pricier. This led to higher prices and fewer jobs both happening at the same time. Nowadays, economists still debate what exactly causes stagflation. Some blame bad economic policies or sudden shocks like major disruption in supplies, like what we saw during the COVID-19 pandemic with shortages in computer parts. Others point to changes in how money works globally, like when the US moved away from tying its currency to gold. So why does it matter? Well, stagflation is like having a headache when you're already feeling sick. It makes everything worse. It means less money in our pockets, higher prices for things we need, and fewer opportunities for work. Economists say the best way to prevent stagflation is to boost productivity, so the economy can grow without prices skyrocketing. Back in the 1970s, the world saw a big dose of stagflation during the OPEC oil embargo. When OPEC countries restricted oil supplies, prices skyrocketed, causing inflation to soar and hitting businesses hard. This led to higher unemployment rates and 2 economic recessions, a tough time for everyone. So, what causes stagflation in the first place? Usually it starts with prices going up for essential things like food and oil. When oil prices rise, everything that needs transporting, like food and goods, gets more expensive. Businesses pass these costs on to consumers, who then start to spend less. This slows down demand, forcing some businesses to lay off workers to stay afloat. That's how stagflation spreads. Stagflation also tends to happen when the efficiency of making stuff goes down. Businesses cutting costs and people spending less can lead to fewer products being made, which drives prices even higher. This cycle of higher prices and fewer jobs is tough to break. For policymakers, tackling stagflation is like walking a tightrope. The usual tricks to lower inflation, like raising interest rates, can make unemployment worse. On the other hand, trying to create more jobs by spending more money can make inflation even worse. It's a tough choice that can impact everyone, from workers to the value of the money we use every day. As of 2022, the question on many economists' minds was whether the US economy might be sliding towards stagflation. A tricky mix of high inflation, slow growth, and rising unemployment. The concern peaks because inflation had soared to levels not seen in 4 decades, prompting the Federal Reserve to swiftly raise interest rates. However, there's some good news amidst the worries. Inflation, though still above the Fed's comfort zone of 2%, has started to slow down. For instance, the latest Consumer Price Index, aka CPI report in May, showed inflation at 3.3% over the past year, a step in the right direction. As of now, there are signs suggesting that the US economy might not be headed towards stagflation. One key factor is the absence of commodity stocks. Sudden increases in prices for essential goods like oil, which historically have been triggers for stagflation. Actually, prices for several commodities have been on the decline recently, including oil. For example, gas prices in the US dropped slightly to around $3.46 per gallon as of June 13th, according to AAA. Analysts even predict that oil prices could continue to fall significantly, possibly dropping below $60 per barrel from their current levels around $79. This downward trend in oil prices helps alleviate concerns about rising costs that can contribute to inflation. Moreover, grocery prices, which had been steadily climbing, recently showed a decline for the first time in a year. While they're not likely to drop back to previous lows anytime soon, this stabilization suggests that inflationary pressures might be easing. However, there's a cautionary note. If the Federal Reserve moves too quickly to lower interest rates, it could potentially reignite inflation. David Miller, a seasoned investment officer, points out that with strong economic indicators, like a robust job market, recently reporting 272,000 new non-farm jobs, the Fed is likely to keep interest rates higher for longer to prevent inflation from picking up again. Miller believes that cutting rates now would risk derailing efforts to keep inflation close to the Fed's target of 2%. He highlights factors like substantial government deficits and ongoing employment strength as reasons why the Fed would hesitate to reduce rates too quickly. To protect against the potential impacts of stagflation, though it's not currently a major concern, investors can take several strategic steps to safeguard their portfolios. Spreading investments across different asset classes like stocks, real estate, and gold can reduce overall risk. Now, growth stocks, which thrive in expanding economies, may struggle during stagflation. Their high valuations and reliance on economic growth for revenue and earnings growth make them vulnerable. Consumer goods and utility stocks, typically overlooked during strong economic growth, can provide stable returns during stagflation. These companies often have steady cash flow and demand for their products even when the economy slows. Investing in dividend-paying stocks can provide a steady income stream, which is valuable during economic downturns like stagflation. These stocks tend to be less volatile and can provide stability amidst market fluctuations. Now, stagflation can lead to misleading headlines about corporate earnings and business struggles. Joseph Camberado, CEO of National Business Capital, advises investors to stay vigilant for exceptional opportunities amidst market volatility. Stocks that appear undervalued during economic contractions may rebound strongly as economic conditions stabilize. Successful investors often take a long-term view, focusing on the fundamentals of companies rather than short-term market fluctuations. For instance, Meta Platforms Inc., formerly Facebook, saw its stock price plummet during challenging times. So, while stagflation creates challenges, it also provides opportunities for smart investors to profit from discounted assets and long-term growth prospects. Diversifying across asset classes, using inflation-protected securities, and maintaining a risk-taking mindset during market downturns can help investors navigate and potentially profit from economic instability. If you enjoyed this video, then don't forget to like, subscribe, and hit that notification bell so you never miss an update. Thanks for watching, and we'll see you next time.